You're scrolling through your feed, and every other post is someone panicking. Oil prices surging. Inflation headlines everywhere. Some guy in a suit on CNBC saying the word recession like he's ordering coffee. Casual, routine, like it doesn't mean anything. And you feel that pit in your stomach, that familiar dread. Because every time the economy gets shaky, it feels like the ground is being ripped out from under regular people. Again. But here's what your feed won't show you. While everyone is panicking, while the comment sections are full of doom and the group chats are full of anxiety, a very specific group of people is quietly getting rich. Not after the crisis, during it. Here's the thing. Because every single major economic disruption in modern history has minted more millionaires than the calm years before it. The 2008 financial collapse, the 2020 pandemic shock. The people who understood what was actually happening, who positioned themselves before the wave hit, they didn't just survive. They came out the other side transformed. Every single indicator is flashing that we're approaching another one of those moments. Oil is being squeezed toward levels we haven't seen since the worst of the energy crisis. My name is Ben, and today, I'm going to walk you through 7 specific actions you can take right now before the 2026 crisis fully unfolds to position yourself on the winning side of what's coming. These aren't abstract theories. These aren't buy my course platitudes. These are concrete, grounded moves based on where commodities, currencies, and capital are actually headed. That was just the setup. Because here's what most people get wrong about crises. They think a crisis destroys wealth. It doesn't. It transfers wealth. From the unprepared to the positioned. From the panicked to the patient. From the people watching the news with their jaw open to the people who saw the news coming 6 months early. The question isn't whether the 2026 crisis will create millionaires. It will. The only question is whether you'll be one of them. Let's get into it. Action 1. Understand the oil squeeze before everyone else does. Right now, most people look at oil prices the way they look at weather. It goes up, it goes down. Not much I can do about it. That's a catastrophic misunderstanding of what's actually unfolding. Global oil supply is being strangled from multiple directions simultaneously. OPEC Plus has been tightening output for months. Geopolitical instability in the Middle East hasn't calmed down. It's intensified. And here's the part nobody's talking about. Years of underinvestment in new drilling and exploration mean that even if demand stays completely flat, supply physically cannot keep up. We've burned through our buffer. There is no buffer. When oil pushed past $140 billion a sack in 2008, it felt like the world was ending. But the people who had exposure to energy before that spike, they made more in a few months than most people make in a decade. The setup right now looks eerily similar. Oil sitting around $80 with every supply constraint tightening at once. Except this time, the supply constraints are arguably worse. Your first move is simple. Get educated on energy markets. Not day trading oil futures. That's a great way to lose your shirt. I'm talking about understanding which energy ETFs track crude prices, which oil producers are undervalued relative to their reserves, and how energy inflation ripples through everything else you own. Because when oil moves, it doesn't move alone. It drags groceries, transportation, manufacturing, and utilities with it. Everything reprices, and that changes everything. This is what I call resource leverage. You're not betting on oil. You're understanding that oil is the engine of the global economy, and when that engine overheats, every single price tag around you changes. The people who understand that connection first don't just win, they win disproportionately. Action 2. Start accumulating gold now, not when it's on the front page. Gold is the asset everyone claims to understand, but almost nobody actually owns. People nod along when someone mentions it as a hedge. Then they go right back to checking their tech stocks. Meanwhile, The people who actually run the global financial system are telling you exactly what they think is coming, with their actions, not their words. Central banks around the world have been buying gold at a pace not seen in over 50 years. China alone added over 300 tons in the last 2 years. India, Turkey, Poland, they're all stockpiling. When the institutions that literally print money are choosing to hold gold instead, that should tell you something profound about where they think this is heading. Let me put this in real numbers. If you'd bought gold at $1,800 in early 2023 and held it through mid-2025, you'd be sitting on a 33% gain, while most people's savings accounts earn them enough for a nice dinner. And analysts are projecting $3,000 to $3,200 as a realistic target heading into 2026. That's not a moonshot prediction. That's the trajectory we're already on. Gold doesn't require you to time anything perfectly. You accumulate, steadily, starting now. A few $100s a month into physical gold or a gold-backed ETF. That's the move. Not dramatic, not exciting, just quietly effective while everyone else waits for permission from a headline that arrives too late. Action 3. Don't sleep on silver. The poor man's gold is a rich man's secret. Everyone talks about gold. Your uncle talks about gold. The guy at the barbershop talks about gold. Financial advisors who haven't updated their playbook since 1987 talk about gold. Almost nobody talks about silver. And that's exactly why silver might be the bigger opportunity sitting right in front of you. Here's what makes silver different from every other precious metal. It lives a double life. On one hand, it's a monetary metal, a store of value, a safe haven, just like gold. On the other hand, it's an industrial workhorse. Silver goes into solar panels, into electronics, into medical devices, into every EV rolling off the assembly line. Silver is literally inside the future, and almost nobody owns any. So silver gets pulled upward by two forces at the same time: fear-driven safe haven demand when the economy looks shaky, and real-world industrial demand that doesn't care about the economy because governments have already committed billions to green energy infrastructure regardless of what happens next. Now here's where it gets interesting. The gold to silver ratio, how many ounces of silver it takes to buy 1 ounce of gold, is sitting around 75 to 1 right now. Historically, that ratio averages closer to 50 to 1. And every single time it's gotten this lopsided in the past, silver hasn't gently corrected. It's snapped back. Hard. In 2020, silver gained over 140% from its March low to the following February. If the ratio corrects to even 50 to 1 with gold at $3,000, you're looking at $60 silver. That's nearly double from where it sits today. A few $100s a month into physical silver or a reputable silver ETF puts you ahead of the overwhelming majority of people who haven't even looked at this trade yet. I think of this as quiet momentum. The advantage you build by accumulating an asset while it's still boring, still overlooked, still sitting in gold shadow. That window is closing faster than most people realize. Action 4. Build a war chest of deployment capital. This is the action nobody wants to hear, because it's the least exciting thing you can do with money. You're going to take a portion of every paycheck and put it somewhere boring. A high-yield money market account, a short-term treasury fund, something liquid, something safe, something that just sits there, and you're not going to touch it. Here's why this matters more than almost anything else on this list. I watched a friend sell his entire gold position in March 2020, 3 weeks before the bottom. He needed the money because he had no cash reserve, no plan, nothing except a portfolio and a panic attack. He's still talking about it, still calculating what those ounces would be worth today. That's what happens when you have no war chest. The crisis doesn't just scare you. It forces you to sell the exact assets that are about to make you wealthy. The people who cleaned up in 2008, in 2020, in every crisis before that, They weren't just smart about what to buy. They were smart about having cash ready to deploy when blood was in the streets. While everyone else was liquidating at the bottom to cover bills, they were buying assets at a 40, 50, sometimes 60% discount. Your war chest isn't dead money. It's a coiled spring. You're not saving it, you're staging it, waiting for the moment when fear peaks and prices bottom. That moment is coming. The only question is whether you'll have ammunition when it arrives. Action 5. Reduce your exposure to the fragile economy. Here's something nobody wants to hear. Most people's entire financial life is built on one assumption: that things keep going the way they've been going. Their income depends on a stable employer. Their retirement depends on the stock market climbing forever. Their lifestyle depends on cheap energy and low interest rates continuing indefinitely. That's not a financial plan. That's a prayer. And prayers don't perform well in a crisis. The 2026 disruption, whether it hits as an energy shock, a currency event, a geopolitical escalation, or some ugly combination of all three, is going to punish one thing above everything else: fragility. If your income comes from one source, you're fragile. If your investments are 100% in equities, you're fragile. If you have no skills that translate outside the job you currently hold, you're fragile. And fragility in a crisis isn't just uncomfortable, it's expensive. It's the thing that forces you to sell your positions at the worst possible moment because you need the cash. It's the thing that keeps you frozen while other people are buying assets at a massive discount. Reducing fragility doesn't mean quitting your job and living off grid somewhere. It means practical, boring, unsexy steps. Start a side income stream, even a small one. Diversify your portfolio across asset classes that don't all bleed at the same time. Learn a skill that people need more of when times get hard, not less. Sales, negotiation, repair work, anything with real-world demand that doesn't evaporate when budgets tighten. The people who got devastated in 2008 weren't stupid. They were concentrated. Every egg in one basket, and that basket was built on assumptions that turned out to be dead wrong. That was just the setup. Action 6. Learn to read the signals, not the headlines. The financial media isn't broken. It's working exactly as designed, to keep you glued to the screen while the people who own the screen are buying assets you've never heard of. That's not a conspiracy. That's a business model, and you're the product. Fear gets clicks, panic gets views, and by the time a crisis is headline news, the smart money has already moved. The people who profit from these moments aren't reading the same headlines you are. They're tracking central bank gold purchases, which are public data, by the way, free, sitting right there on the World Gold Council website. They're monitoring the dollar index. They're watching OPEC production reports months before oil prices react. They're reading the bond curve like a weather forecast for the economy. The information is free. The edge it gives you is enormous. And almost nobody bothers, because it's less entertaining than watching someone scream about the market on cable television. 30 minutes a week. That's all it takes. A simple watch list. The DXY, the 10-year yield, OPEC output data, central bank gold purchases. Track those 4 things, and you'll see the crisis forming months before your coworker mentions it at the water cooler. Action 7. Adopt a crisis investor's mindset before the crisis hits. This is the one that ties everything else together. Because you can buy all the gold you want, you can stack silver, you can study oil charts until your eyes bleed. But if your brain is still wired like a consumer instead of a crisis investor, you will panic sell at the exact worst moment and hand your gains to someone with steadier nerves. That's not hypothetical. That's historical fact. Every single crisis follows the same emotional pattern. First, denial. it won't be that bad. Then fear. Oh God, it's that bad. Then capitulation. People dump everything at the bottom just to make the pain stop. And then, quietly, recovery. The people who held, the people who actually bought during the capitulation phase, they're the ones writing the success stories you read about 3 years later. The difference between those people and everyone else isn't intelligence. It isn't insider access. It's mindset. They decided before the storm hit what they were going to do when things got ugly. They had a plan. They had conviction in their positions. And most importantly, they had already made peace with the fact that their portfolio would look terrifying for a while. Here's what actually separates crisis millionaires from crisis casualties. The millionaires treated volatility as a purchase opportunity. The casualties treated it as a signal to run. Same event, same market, completely opposite outcomes, based entirely on a decision made months or years earlier. So here's what I want you to do, and this costs nothing. Write down your crisis plan. Literally, write it down. What will you hold no matter what? What will you buy more of if prices drop by a third? At what point do you deploy your war chest? What would make you sell and what absolutely would not? When you make those decisions now with a clear head in a calm market, you remove your future self from the most dangerous environment in investing, a panicking crowd with a sell button. So now you've got the 7 actions, but knowing what to do and actually doing it in the right order are 2 completely different animals. Let me give you the practical sequence, a rhythm you can start this week. Week 1, you audit your current portfolio, every single position, and you ask one question about each one. If oil hits $150 and the dollar weakens significantly, does this holding survive or suffer? Be honest. If everything you own depends on cheap energy and a strong dollar, you're not diversified. You're concentrated in one bet, and you don't even realize it. Week 2. You open a dedicated position in physical gold or a gold-backed ETF. The point isn't the amount. The point is you've crossed the psychological line from spectator to participant. Most people never cross that line. Week 3. You do the same with silver. Separate position. Remember the gold to silver ratio. When that snaps back, you want to already be holding. Week 4. You set up your war chest. High yield money market. Automatic transfers from every paycheck. You don't touch this money. You let it accumulate like a coiled spring, waiting for the moment when fear peaks and prices bottom. And then, ongoing. 30 minutes every weekend. You check the signals, not the headlines, the bond curve, the DXY, OPEC reports, central bank gold purchases. Half an hour. Less time than you spend scrolling through the panic on your feed. None of those moves matters in isolation. Together, that's resource leverage working across every dimension of your financial life. The crisis doesn't reward the people who react fastest. It rewards the people who prepared earliest. And preparation isn't dramatic. It's boring. It's repetitive. It's a weekly rhythm that nobody sees until the results become impossible to ignore. You don't need all 7 tomorrow. You need 1 today. Because the 2026 crisis isn't going to send you a calendar invite. It's not going to wait until you feel ready. It's going to arrive the way every crisis arrives. Suddenly, for the people who weren't paying attention, and right on schedule for the people who were. The wealth transfer is coming. It always does. And the only variable that matters is which side of that transfer you're standing on when it hits. 10 years from now, you're going to look back at this moment, mid-2025. The signals were everywhere. Oil tightening, gold surging, silver coiled, the data screaming at anyone willing to listen. And you'll either be the person who took one small step when it still mattered, or the person who kept scrolling. Start with one. Start today. Because the people who act early don't just survive what's coming. They're the ones who come out the other side unrecognizable. My name is Ben. I'll see you in the next one.